So hi everybody, this is Hustle Hub. I'm Jaco, and today I'm with Austin Harrison. He's a CFA and CMT charter holder. He runs Grindstone Intelligence, and today he is going to talk about the state of the market as of now for the American market. So Austin, please introduce yourself, and then let's get into the content.
Yeah, I'm glad to be on. We've been trying to get this figured out for a couple months, so glad we were able to finally get on. So some quick background on me. I am the chief market strategist and co-founder of Grindstone Intelligence. We're an independent investment research company that we started at the end of last year. That really grew out of a blog called Means to a Trend that I started writing a couple years ago. I really enjoyed doing that. So now with Grindstone, I get to put out even more content, more weekly and monthly notes for subscribers. So, if you're interested in that, I encourage you to go check out Grindstone, sign up for our free newsletters because we're sending out quite a bit every week.
Okay, the link will be in the description of the video, so you can go and check out that one.
Yeah, thank you. I also just hit my 8-year anniversary at an advisory firm here in Kansas City, Missouri, where I'm an investment strategist. So, I get to help with the investment decision making and trading for a few hundred accounts and a couple $100 million. So, being here has really given me the opportunity to learn from and work with some really great people. So I thought today, since this is the first time I've been on with you guys, I thought I'd just kind of share my general approach to the markets and then try to burn through some charts and talk about our current landscape. So before we get started on that, just want to remind everybody that everything we say here is for educational and informational purposes only. Grindstone is an independent publisher. We're not a registered securities broker, not an investment advisor. So nothing we talk about should ever be construed as a recommendation to buy or sell a security. Nothing we discuss is going to take into account your individual financial circumstances. Investing in securities is speculative. It carries a high degree of risk, so be sure to do your own research and consult a qualified financial professional. If you want more on that, you can go check out grindstoneintelligence.com/terms and conditions. So now that we got that out of the way, so my general philosophy on investing is this. Index investing is really hard to beat, but it's hard to stick to too, because we're all just a bunch of dumb animals and we're susceptible to behavioral flaws. So even if we say we're passive investors, we might feel differently if returns don't live up to our expectations over 10, 15, or 20-year periods, because looking at history, we know that stocks can absolutely have poor returns for 20-year periods or more. So I think that the more sustainable way to stay invested is to focus on managing risk. So I take weight of the evidence-based approach, try to focus on the data, tune out the noise, and weld together both fundamental and technical analysis. I think that if we do that, we can stack the odds of success in our favor. I'm also a big believer in owning relative strength. If you want to outperform the market, then you've got to own the things that are outperforming the market. And I think if you do all those things well enough, then you're going to be putting your portfolio and in your longer term financial plan in a much better position. So when I talk about blending together fundamental and technical analysis, this is what I'm talking about. So there's two parts of building a portfolio. You've got asset allocation and security selection. For asset allocation, we're looking at the big picture stuff. On the macro side, is economic growth accelerating? What can we expect from central bank policy? Is the consumer healthy? What's the outlook for inflation? Are businesses spending? Are they investing? Are they growing? And then on the technical side, what trends are we seeing in stocks, bonds, and commodities? How's market breadth? What is sentiment like? How are people positioned? So obviously these things are changing constantly. But when we see times when when those two outlooks overlap, I think those are when we have our best opportunities, and that's when we're stacking the odds in our favor. The same thing goes for security selection. So here, instead of asking, do we want to own stocks or bonds, we're asking, which stock do I want to buy? Over the long term, we know that there's only a handful of stocks that drive the majority of index returns. And that's a big reason why most stock pickers are underperforming, right? It's because most stocks underperform over the long term. But we also know that those best stocks, those ones that are on the fat tail of the distribution curve, those are the stocks that are going to have both the best fundamentals and the best technicals. So we know that over the long term, the best fundamental stocks, I guess we're looking for the same things when we're looking at fundamental and technical analysis. We're just taking different approaches. So again, when we see those areas overlap, that's when we're going to have our best opportunities to outperform. So obviously, trying to go through all of those little circles is going to be too much to cover today. I know Giacomo's had some great guests on in the past that just do a fantastic job covering the macro. I've watched a lot of those videos, and so what I'd really like to drill on today is the bigger picture technical landscape, which is primarily what I'm focusing on in the published work at Grindstone 2. So the first question we need to ask is, do we want to own stocks? And if yes, then which stocks, and where should we be putting our attention? And then after that, what are the risks to our outlook? Because we're in a business that we're going to be wrong quite a bit. So we need to be clear with ourselves up front about what evidence we're looking for that would say, hey, maybe we need to be changing our view. So with that, do we want to own stocks? What are we seeing at kind of the big picture view? So this is the S&P 500 index, which holds 500 biggest and most important companies in the US. I'd argue it's one of the most important indexes in the world, if not the most important index in the world. Right now, we're breaking out to 8-month highs. That's not bearish. So, we've been watching this level between 4,100 and 4,200 on the S&P 500 all year. And what we've been saying is that, as long as stocks were below that level, we can't be declaring a new bull market in stocks. But now we're above it. So I don't see how we can be bearish stocks as long as we're above that level. So we want to be looking for stocks to buy. We're seeing interest rates supporting that view too. All throughout 2022, when stocks were getting crushed, it was interest rates moving higher, dollar moving higher, that was pressuring stocks. So, that was our big headwind. But then, interest rates peaked back in October at the same time stocks bottomed. They really haven't gone anywhere since. So it's not just the level of rates here that matters. Obviously, if we look at financing and liquidity conditions, those are a lot different than they were a couple of years ago. Rates are almost double what they were. But as long as that trend in rates is stable, stocks can deal with that. Stocks can keep moving higher. Same thing goes for the dollar. The dollar index was ripping higher all throughout the first part of 2022. That was pushing out stocks lower. And then, again, last fall, you see the dollar peak, you see stocks bottom. And then as the dollar fell off, that's when stocks got going. And then all throughout this year, the dollar's no longer falling, but it's at least stable. And that's okay, because that's really all we needed was for the dollar to stop going up. And we can see that, with the dollar in the S&P and rates in the S&P. So last year we had basically the strongest negative correlations that we'd seen in a decade or more between those things. So now there's almost no correlation between stocks and currencies. The correlation between rates and stocks is actually positive. So just going back to that original thesis, if rates and currencies were the problem last year and they're no longer the problem, then why wouldn't we want to own stocks? So which stocks do we want to own? I was taught that if you want to outperform the market, then you have to own the stuff that's outperforming the market. So we're looking for relative strength. And right now that's in growth. So there are 11 sectors in the S&P 500. I like to break those into 3 groups. In that first group, call it growth. You've got the tech sector, you've got communication services and consumer discretionary. This is where you have stocks like Apple, Microsoft, Google, NVIDIA, Amazon, Tesla, all these companies that are kind of on the cutting edge of society. They tend to be, the most exciting companies. They have the higher valuations, higher risk, but they also have, the best long-term growth prospects. I sometimes call them the beauty sectors. Then you've got the value group, or the brawn, industrials, financials, materials, energy. These are your traditional cyclical areas, tend to be more focused on the goods and manufacturing side of the economy. And then finally, the safety sectors, or the boring sectors. These are the places that tend to be least exposed to economic growth. They have the least upside during growth cycles, but tend to be less volatile on the downside. So we're talking about utility companies, consumer staples, healthcare, real estate. So, when we look at this chart, we can see pretty clearly what the dominant force has been this year. It's those high-flying growth stocks. Tech and communications both up 30% for the year. Consumer discretionary up over 20%, but everything else, flat to down. It's the complete opposite of last year, where it was the growth stocks that were getting crushed, while your boring sectors, your value sectors, were really holding up pretty well, considering we were in the midst of a bear market. Real estate was an outlier. That sector is really just tied to interest rates. So we already talked about the big impact that interest rates had last year. And then, of course, energy, just screaming all throughout last year, thanks to higher oil prices. But we really saw that trend change and a shift in leadership when we start looking at the communication sector. So here we're looking at the sector relative to the S&P 500. So we're just taking the price of one index, dividing it by the other. So when this line is going up and to the right, communications is showing relative strength. Down and to the right, it's showing relative weakness and underperforming. So we can pretty clearly see all that weakness last year, right? You got the ratio below a 200-day moving average for the entire year, kept setting lower highs, lower lows. But then at year end, clearly see a change. First, you break the downtrend line, then you see it get above the 200-day moving average. Then, you get 4 to 5 months of consolidation, and then a breakout, last month above resistance. So it really looks like we've got a new relative uptrend in communication services. In tech, we've got even more strength. So this has been one of my favorite charts for the past few years. We've got tech going all the way back to its dot-com bubble highs when we're looking at relative to the S&P 500. So it goes all the way back to those highs, gets rejected, and that really kicked off last year's bear market. So just textbook response to those former highs. But now we're at new all-time highs for tech. So we can't be bearish about tech if it's setting new highs. Look, there's going to be people that are watching this that look at this chart and say, hey, this has to be unsustainable, right? Because tech stocks are even more expensive than they were in the dot-com bubble. But that's really not what this is saying. Because for the last 23 years, the fundamental situation in these tech stocks has been improving, right? Earnings have been growing faster in tech than they have in the rest of the market. So really from that fundamental look, we're not at all comparable to where we were back at the height of the dot-com bubble. It's just price is finally confirming that strength that we've been seeing. And here's a closer look at that breakout, and really just my favorite example of why we use technical analysis and ratio analysis here. I mean, just look at how cleanly we respected those 2000 highs on this chart. I mean, these are prices from 23 years ago, but price has memory. You know, just rejected, you know, those 2000 monthly highs, finally get through them, get rejected at the weekly highs, you know, and then at the end of the year, you had tech breaking down to new lows. You know, I remember when that was happening, I was sitting there looking at this chart thinking, hey, this isn't good. You know, it looked like we were heading back to the October lows for stocks. And then a week later, you know, we're right back above it. And so often you see these failed moves result in fast moves in the opposite direction. That's exactly what we got. Now here we are, tech's at new all-time highs. So what's next? You know, I'm thinking a pause here probably makes some sense for growth. We've had a great run. Semiconductors been on a great run, but now that semis sub-industry is right back to where it was last year at its highs. So could we blow past resistance? Absolutely. But I think it would make sense to see this group take a breather. And by that, I don't mean that we need to be, you know, going out and shorting every semiconductor stock we can find. I don't think we need to be necessarily turning bearish. I'm just saying, you know, it makes sense that we would see a pause here, maybe build up some energy before the next move higher. I think that would make sense in that communication services sector too. So here we're just zooming out on that chart we were looking at a minute ago of communications relative to the S&P 500. And we're back to those highs from last summer, which also happened to be the lows from 2018. So a pause here would make sense. And just here's one more. You know, you've got the equally weighted tech sector versus the equally weighted S&P 500 sector or index. So kind of looking at like an average tech stock versus an average S&P 500 stock, where we're really trying to strip out the outsized impact of all those really big companies. So, you know, here we're looking at this ratio running into resistance at the former highs. So once again, just would make some sense to see some backing and filling here. So if it's not growth that's going to lead us higher, you know, where should we be looking? You know, why not industrials? This was really one of the best performers last year, especially, you know, coming out of the October lows. You know, just look at this breakout and just huge runabout performance following those October lows. But then kind of forgotten this year, left behind by all this rally in big tech. But now potentially finding some support here at that initial breakout point from last fall. And things look even better if we strip out that market cap effect again. So here we're looking at the equally weighted industrials versus the equally weighted S&P 500 index. Just a ton of relative strength in the sector, you know, breaking out to new relative highs. So, I mean, how can we not like that? And, you know, why can't we see rotation back into the other value sectors? I mean, everyone wanted to say financials were dead when the banking crisis got started in March, and for good reason. You know, those regional banking stocks got absolutely torched. Things look pretty scary, but, you know, the sector overall never even got below those 2000 highs that preceded the great financial crisis. So, you know, they continue to hold above that key technical level of support. And as long as that's that case, I don't see how we can really say things are all that bad for financials. There's no reason that we can't see rotation back into that space. Same thing for energy. You know, this has been really beaten down this year, but this is a pretty logical spot to find some support on a relative basis. This is where things really started to get nasty back in 2020, where you saw clear acceleration in the downtrend. And then last year, it was some nice rotation. You saw a couple of peaks there and then a nice rounded bottom. So it would make sense for the sector to find some support here and take a leadership position in the near term. And that's exactly what we want to see. Rotation really is the lifeblood of bull markets. So you get one group leading, then the next, and then back to the first one. And that's how you get sustained uptrends. So, the risk here is that growth stocks stall out, like we were talking about, and then nobody else steps up and takes a leadership position. And then that's when we've got something that starts to look unhealthy. So that's what could go wrong, is we could not get rotation. Breadth has been notoriously weak to start the year. We see it everywhere we look, just everybody talking about how the biggest stocks are driving all the gains in the S&P 500. And that's fair points. If you look at the number of S&P 500 stocks that are above their 200-day moving average, that peaked back in February. So if you use that as just kind of a litmus test for trends, you're seeing fewer and fewer stocks in uptrends, while the index has been, moving higher and higher. So that's something that needs to be corrected if we want to see a healthy and long-term bull market. Just over the past couple of weeks, we've seen that improve quite a bit, but we still got a long way to go. Same thing goes for new highs. We need to see more stocks hitting new highs. So this is the number of new highs on the New York Stock Exchange minus the number of new lows on the New York Stock Exchange, and we're taking a 20-day average. So just to kind of take out those daily volatile swings, and we're still seeing more new lows than new highs. So that's just not something that's consistent with new bull markets. It is fair to say that, we need some time for stocks to hit new highs. We just went through an extended bear market, but we still need to see fewer stocks hitting new lows at least. So I think this is where we would see it if we have a problem. If these indexes that haven't been participating and moving higher start setting new lows, I think then the caution flags really got to come out. So this is the value line geometric index, which is basically just the performance of the average stock. So you can see that was trending lower all throughout 2022, and then similar to our list of stocks that were above their 200-day moving average, this peaked back in February. So I think if this is down below that 530 level that we've got, then I think my blood pressure is going to go up a little bit if we see that. Then there's the Russell 2000 small cap index. This has been a laggard all year, but kind of surprising. It was actually the first to bottom last year. So this is an index that's been consolidating above those pre-COVID highs for 12 months. If we're going to see an extended bull market, then I think we need to see the Russell participating, moving higher, or at the very least hanging where it is. But if the Russell is breaking down below those pre-COVID highs, then I think we've got a problem. I don't think large cap stocks are going to be able to just shake that off. Same thing for those financials that we were looking at. How bearish can we be if financials are holding above key support, right? But what if we're not? If financials are not above that support level, then I think that's going to be a clear signal that something is wrong. So, just going back to our S&P 500, if we're getting all those breakdowns in those laggards, then I don't think we're going to see the S&P 500 still hanging above, 4,100 to 4,200. And if that's the case, then, we need to be approaching stocks from a more neutral or maybe even a bearish perspective. So that's the way I'm looking at things. I think right now we need to be erring on the bullish side. I'm hoping we see some rotation out of growth and into value over the near term. But longer term, there's a ton of relative strength in those growth sectors. And then, if we start to see those laggards break down, then we need to take a step back and reassess what we're doing. So That wraps up kind of my charts for today. So I hope you guys were able to learn something and maybe take something away from it. Posting charts like this pretty regularly on Twitter. You can find me at Means to a Trend. And then, Giacomo noted that he's going to put the link to our website in the description so you can sign up to receive that free newsletter. So yeah, I don't know if you got any
Yeah,
follow-up.
I will. So one question that I have is, so the first question that comes to my mind, given the fact that one of the big drivers of the market has been technology, and you mentioned like IT, semiconductors, and so on. Do you have a take on the recent news that came out that the CIA director had a trip to China, and looks like maybe in the short run, there it is more likely that the relations won't get worse. Do you have a take on that? And could that affect the semiconductor market, which has been such a driver of the growth for now?
Yeah. I mean, obviously, geopolitical risks are always top of mind. I would not want to step out and pretend to be an expert on how those could play out. You know, like I said, we've got semiconductors, that sub industry going back to those former highs. So you could have negative headlines that come out and kind of confirm that, and see some semiconductors back off here. You know, I don't know what's going to come out of Washington or out of Beijing at any time. So
Yeah, because that is a sector that in the last year and a half has been very affected by these relations, And another question I have: what is your take on inflation? Because we saw the graph of how the Fed has behaved thus far and its relation to the market. What is your take on the Fed and what is likely to come in the near future?
yeah, so we've got a meeting next week. Seems like consensus is that we'll get a pause next week, or at least no hike. Although there's still a chance that we get one, depending on how that inflation reading comes out next week. I would not be surprised to see another 25 to 50 basis points in hikes by the end of the year. But I think really, to the extent that rates stay where they are, we were looking at that long-term 30-year Treasury yield earlier in the chart book. As long as that stays within the range that we were talking about, I don't know that that's necessarily a problem. A 25 or 50 basis point difference in your terminal Fed funds rate, that has pretty marginal impact on stocks. I think the bigger scare would be if we start saying, hey, we're going to get another 100 to 200 basis points next year. In addition to that, if inflation doesn't start cooling, then I think you've got a bigger problem. But as rents come down, as housing inflation comes out, I think that's going to be a tailwind to drive inflation lower. And then we'll see obviously what happens with energy. That's been a huge driver of inflation. So I'm not an economist, so I'm looking at the same things you guys are, but it would seem that inflation is at least heading the right direction. We'll see how the rest of the year plays out, obviously, but I'm hoping that the Fed is kind of a rearview mirror at this point, and then we can just focus on the trends at this point.
Okay. And the last question that I have for you is, I don't know if you read some of the headlines lately, but what do you make of the OPEC situation, and what are the sectors that could come out as winners in the near future as a result of that? Energy, but yeah.
So I've taken a look at historical OPEC production cuts, and it's really a mixed bag. So, you know, we saw the cuts earlier this year that led to kind of a short-term spike in oil, but then oil fell right back to the lows. And then, you know, last weekend, or I guess week and a half ago, you had OPEC, or I guess the Saudis come out and say that they were going to cut production more voluntarily, and that had less of an impact on oil. So it's hard to say, you know, how much these OPEC production changes are actually going to affect prices longer term. You know, obviously higher oil is going to be good for the energy sector. You know, you could also see some tailwinds touching the industrial sector with some of those stocks that supply the energy market. You know, if oil continues lower and you don't see the positive impact from OPEC production cuts, because remember, like OPEC is cutting production because they see weak economic outlook, right? So like demand is falling, so that's why they're cutting. So if they're not cutting fast enough to offset the weak demand, then oil prices are going to continue lower. I see, you know, you've got the same impacts there, where, you know, energy stocks are not going to like that. You're going to see less CapEx in that space. But then, you know, on the flip side, if you see lower oil prices, that's going to be a tailwind to profit margins for all these sectors and industries that have been, you know, dealing with transportation costs or just energy cost in general. So.
Okay. So I'm done with the questions. Thank you a lot for your time and for this presentation. So if you have anything to add, feel free to do so. If not, I really want to thank you, Austin, for your time and your availability.
Yeah, thank you for having me on.
Okay, so this is it for today. I'm Giacomo. This is Hustle Hub. See you next time.